High walls rise again. Markets tremble in the winds. Tiny hands tighten their grip.
Welcome to the 60/40 podcast. 60/40 is the only podcast that deep dives Asia's top business and tech headlines from the leaders actually driving the change. Asia accounts for 60% of the world's population and 40% of its economy, and we're here to provide unfiltered commentary, insights, and occasional speculation on what's really going on. For our first episode, I'm here with my co-host, Prashant, a serial fintech founder who has built and exited 3 companies in Silicon Valley and India and is now onto his 4th. Peter Bithos, our consummate executive, if you can't tell by the tuxedo, with experience in mobile, streaming, telco, and now at the talent revolution. And he's also our resident poet. We are sadly missing our 4th co-host today, Huey Lin. She's Singapore's most popular person, which is why she can't be here. But never fear, because we are lucky enough to be joined by our very first guest, Raghav Kapoor, the founder and CEO of SmartKarma, an investment research and intelligence platform. So before we jump in, I should note that none of us are professional journalists or investment advisors. So all opinions expressed on this show are purely for informational and entertainment purposes. Okay, first topic we have is India's IPO market and the general market sentiment in India. So to kick us off on the headline, Lenskart recently announced plans for a $1 billion IPO on the National Stock Exchange of India at a $10 billion valuation. This is happening as people are also like hullabahooing about the Nifty 50 dropping by 16% since its highs last September. And there's some talks about a bear market in India. And people are basically just speculating, in the media and then on X as to how India's markets got overheated. So Prashant, can you kick us off? Do you agree that the NSE has been overheated? And what do you take about the current market correction?
Yeah, so there's a few things going on, and I think we need to kind of unpack them a little more systematically so that we have the full context of understanding the market itself and the peculiarities of the market, right? So first of all, I think it's important to note that almost 50% of India's mutual fund investors are actually very new and very young, right? So these investors didn't exist prior to 2021, and so they've come onto the market since, right? The other big factor that plays into the India market is the foreign institutional investors, who kind of play a very big role in looking at India and investing in India. And India has always been the beacon for emerging market investments. Now, of course, there's a whole bunch of things happening around the world, and that's no secret. And I think with the global market uncertainty, the first thing that happens is typically FIIs, or the foreign institutional investors, look to kind of capitalize some of their profits, crystallize that, and then pull away either into home markets or into other markets, right? So what we have seen over the last year or so is that a lot of the foreign investment into India has kind of been captured in terms of gains and has been slowly pulled back. It could be various reasons for this. One is there could be speculation around the currency depreciation in INR. So effectively, some of the earnings could see lower dollar returns. So that could be one of the factors. The second could be a divestment from India into other emerging markets or into home markets, and I think that's a big factor that plays in. But we have to also understand that India does have a large consumption base, a domestic consumption base, and that has actually stepped in to kind of fill in this gap. The only factor to kind of throttle in this conversation or in this thought process is these are relatively new investors, right? They've only seen the ups since 2021, since they came onto the market. A lot of them enjoy the futures and options kind of playbook, which is not open to them on the international markets. It's only available to them on the domestic markets. A lot of them like the crypto-like growth, but crypto is effectively unsavory in India, or banned in India, or very hard to play in India. So you actually often find them in the retail space. So I think that's, it'll be important to watch how they actually respond to the falling of the Nifty, right? And by the way, it's not a huge drop, right? So we're seeing a pretty we saw a good run up till September of 2024, and since then it's dropped about 15%. And I think globally, if you contrast it with other drops, it's not a spectacular drop. It's not like the bottom has come off. It's just shaved off a little bit and perhaps corrected for some of the exuberance that the market had seen. The other factor that's played in is actually since 2020. Where India had a CRR or cash reserve ratio of 3%, which is an all-time low, the RBI systematically increased it till about until the point of about 4.5%, and then that came off to about 4% towards the end of 2024 as well. And what that does is typically that means the banks don't keep as much in terms of reserves. They actually put it back to play, which means there's a little bit more money sloshing around in the system, and that money finds itself into capital markets. And I think we will talk a little bit about some of the cappings in terms of foreign investments, that are imposed by the RBI, which means that extra cash kind of finds its way into the domestic markets, driving up some of the prices. So I think there is a signal that India has been priced to perfection in 2024, that the prices were high, which gave the signal to some of the foreign investors that this was a good time to cash out. That combined with the high interest rates globally and some of the uncertainty with the new geopolitical changes around the world, perhaps investors wanting to pull back their money into their home markets or other emerging markets away from India. So I think that's what we're seeing. I think there's a strong domestic consumption base. I don't think there's a little bit of correction, but I don't think the bottom falls out from here.
I think, first of all, I think it's great that India's realized that gravity still works insofar as the market's concerned. But I think it's no coincidence that the Chinese market started rallying at around the same time. So if you unpack this, there's been very little new money being added to emerging market allocations from global allocators. So if you've got the same amount of money and you've got a very large underweight in China, which it's starting to hurt you now, you need to take money off the table somewhere to now put it to work in China. And that's what happened in India. India's been the ATM market, as I would call it, and people have just withdrawn money to put it to work in China.
Yeah.
Peter, what are your thoughts? I mean, I think there's also been some talk about, Prashant mentioned the large domestic consumption market and then the FII is pulling out. I think there's also been some talk about some of the regulatory and the monetary policies in India that have an effect on this too. So if you want to go back to your university economic days.
Yes, I will go back to my university economic days. And so for everybody out there, so first of all, I think all those comments are very interesting and insightful. My experience, both personally, and then if you go back to classical economics, if you're investing in India, either as a company or as an individual shareholder, and you are trying to game it in the short term, you might as well go to a casino and put it all on black and hope it comes up. Because,
is that what you're doing right now?
That's exactly right. Well, it's on theme. It's on brand right now. A butterfly flaps its wings in Colombia. Modi goes to the bathroom on Thursday, doesn't feel great. And, poof, the market goes down 5%, right? So the experience in India is you invest in India, in equities in India, or a company that you really have conviction in. You were there for 5 years and 10 years because you are investing for a long-term trend. If you want to invest for short-term gains, you might as well put it on Dogecoin or something like that.
But that's exactly what the retail guys in India were doing.
Correct.
Yeah, it's exactly. I mean, an app pops on the App Store and allows sophisticated investing for the local Indian punter, and all of a sudden the stock market does X. So it is very much like investing in India as a company. You do not invest in India as a company and go, I'm going to have a 3-year business case and make money in 3 years. No, you go in for 10 years, 20 years, and you bet on the demographic reality of India becoming a power over a generation.
Okay.
And that's the way I think about investing.
Okay. So all of y'all are, pretty optimistic here, and this is a slight market correction, but nothing terrifying, and it's all fine. But I do want to talk about the impact on the startup IPO market, because like last year was really good, right? Last year, I think there were 13 different IPOs from the startup and tech community, and I read like 25 in the pipelines potentially for this year. But if the market is slightly correcting, do you think there's that appetite, and do you think these startups are going to get the type of exit that they're looking for?
Yeah, so I think even if you look at the companies that IPO'd last year and how they're faring now, right, you'll see certain companies that have hard assets or have like solid business cases, were profitable to begin with. They've continued to kind of keep course and kind of may have actually had a lift in prices. But companies that were in search of a path to profitability or were on the verge of profitability, exploiting some inefficiency in the market, but haven't quite gotten there, I think they have been punished. And I think the signal in the market is that I think as the young amateur investor continues to reel from the pain of their first set of losses in their lifetime of investments, which is a whopping 4 years, I think now the more institutional, more seasoned investors continue to reward like well-established, solid business model companies. And I think I agree with Peter. Someone gave me this advice. If you play India, you play very, very long, right? It's a country. Everything takes a little bit longer, but once it starts to work, it works very, very well. So there is no short, quick, speculative play. And I think that's what I think a lot of investors are also realizing. But I do think even now, if you look at the pharma space or the FMCG space or the IT space, I think these are spaces that still kind of form a little bit of a bedrock. And some of the heavy industrials also continue to remain the bedrock. It's the new business models that I think have come off. The shine has come off a little bit. So.
I mean, actually, I think if we look at the first wave of big tech listings in India, and by tech, I don't mean IT services, like the Zomatos of the world, it took a while for them to find footing, but they found great footing. And actually, just from speaking to public market investors, which is what we do at SmartKarma, I think a lot of them missed them. And I think there's career risk this time of missing out on the good ones.
Can't do that again.
Can't do that again. Yeah. Right. So I think there is universal pressure on at least the institutional investor community to not miss out on good tech listings, right? And you kind of qualified what's good and what's not good. So I'm not that worried. And if anything, if sort of the valuation expectations of the corporates that are issuing stock come down a little bit, it's probably good. Okay. It probably means more returns post-listing.
All right. Let's close out this segment with a rumor. What's happening with PayU? They're on the IPO list.
Yeah, look, I haven't been at PayU for a couple of years now. And I think at the time, obviously it's public news, we were preparing for an IPO. I think it looked good. Still a good asset. But I think like PayU, Pine Labs, there's a few companies there in that pipeline that I think are good, solid, well-established, licensed players. And I think they will continue to kind of bear the torch for good IPOs. Okay.
I mean, if it's a tale of two cities, like if you're already profitable and the IPO is going to be great for you, and then if you're not profitable, the IPO probably isn't going to do that much for you, then it just further bifurcates like that field, the playing field. Okay, let's move on to the media's favorite person, but not mine, Trump. Trump is aggressively pursuing tariffs in his second term. He has slapped on two different sets of 10% tariffs to China specifically, first time in February, and then once again just 2 days ago on March 4th. This is actually on top of some leftover tariffs from his first administration. So I think the average tariff rate now on Chinese goods going into the U.S. is something like 34%. Peter, what are your thoughts on this? And do you have a little ditty you would like to share?
I do. It's not a ditty, it's a haiku. Okay. Is that okay? I think there are many different, as a poet, you have to practice many different forms of poetry. So this one's a haiku. High walls rise again. Markets tremble in the winds. Tiny hands tighten their grip.
That was amazing. Thank you.
Yeah, thank you. So
Okay.
Wow.
And it's a wrap.
And we're done for today. Thank you so much for tuning in.
Exactly.
Can't beat that.
But,
Stay tuned next week.
Okay, but what is the end game for these tiny hands? Like, where does the world? Is there any possible resolution?
I'm not going to be the one who tries to get into Trump's mind. That would be a dangerous exercise. But maybe if you bring it a little bit closer to home, in this neck of the woods, right? So Southeast Asia, this region. If you look at the economies, the thing most people forget is most of the economies around the region are consumption based. And when you look at exports as a percentage of GDP, really it's only Vietnam that kind of hits, and Thailand hits, but that's only because tourism is classified as an export, and tourism doesn't really have a tariff attached to it, at least not yet. I'm sure Trump will find a way. So look, I think the dynamic for Southeast Asia, if you just look at the data, is, compared to markets like China, if the world catches a cold, we're all screwed. So that's reality. But aside from that, on a more regional basis, the exception of maybe Vietnam, most of the economies are far less exposed to, say, a China or Mexico or Canada. Those Canucks are really hating it right now. I think it's where the winds of the world go, and who knows how that's going to play out.
Are there any winners in a tariff? I mean, in a tariff war, can ASEAN band together? I saw some calls from the Malaysian Minister of Investment, or saying we need to increase intra-ASEAN trade in order to offset the effects of this.
Nah. I think what's the
we're all screwed.
What's the opposite of winner take all? I think it's kind of that.
Losers lose all.
Yeah, loser loses all, and everybody's a loser here. No, I mean, look from my perspective, right? First of all, everything that's been announced on China right now is better than expected. I think every corporate participant that we speak to was expecting way worse. They were expecting 60% on day one.
Oh, okay.
Yeah. So it's better than expectations. You look at the NPC this week, tariffs was a non-issue. So I think China's come into this very well prepared. And all the domestic headwinds that China was facing are all becoming tailwinds right now. So you've got one major global economy on the mend with interest rates at 2%. So deflation pretty much, with a lot of room to expand both on the fiscal and monetary side, and the green light just went on Wednesday. So I think that's looking good. That's the saving grace, weirdly. The US looks pretty much one of the bigger losers right now.
Yeah.
I think basic 101, this is inflationary. All this protectionism goes against global trade, which has been the biggest force of deflation. That's unwinding. I think everything that's happened with Ukraine over the last 1 week, Europe stepping up to increase their defense budgets, yields have gone for a toss in Europe, problem. So I think bad news, but I think we're at the risk of a pretty serious correction, short term. And all of it has been manufactured, with tariffs basically making sure it happens pretty much.
Yeah.
I think China will come out of it looking pretty good.
Yeah.
So that's probably the winner.
Southeast Asia might pick up some investment. I mean, that's the classic line. They're like, oh, well, people are offshoring from China.
Singapore is a big exporter, net exporter.
Yeah.
I think Vietnam, as Peter mentioned, is next on the chopping block. Malaysia is the big growth driver has been tech exports, which could come under pressure, plus energy, oil.
Yeah.
That's again, OECD is increasing supply under pressure to bring down energy prices. So that's not looking good. Indonesia has got its own set of issues going on right now. That's episode 2, I'm guessing. So that's not looking great. So I don't think the Southeast Asian story looks that good. Philippines perhaps is the only outlier. But it's from a global investor perspective, it's less
a small fry.
It's not even 2% of the benchmark for Asia at the moment.
Yeah.
So,
but every Filipino right now is like, thank you for the shout out.
Yeah, love the market.
Not to state the unpopular view, but like, look, I think in some ways, a lot of this is also, while there are tariffs and they are real and they are coming on April 2nd in many ways, and some have already come into play, I do think there's a lot of posturing in this as well. Yeah. And I think this is a lot of come to the table, let's negotiate, let's create a level playing field. I think Trump, we all have our opinions and the media loves to hate. But I think at the end of the day, for once, I think if we were to really look at the message behind the message, I think he's trying to say, hey, look, this is America first. Like, we got to protect America. We can't just keep ballooning the deficit, and we can't have, products being dumped by countries where there is artificial controls on currency and valuation. So I do think net, while in the short term, I agree 100%, like there are no winners here. But I think in the long term, if America shaves off its debt, I think that is going to be very good for the world. Yeah. And I think you can't just look at tariffs in isolation. You have to look at tariffs in conjunction with what's happening with Doge and what's happening with spends and what's happening with just creating a slightly more level playing field. Because I think in the long run, what I would fear 10 years from now, 20 years from now is had we just continued the path we were on, I think we would have faced a much bigger problem where America's deficit becomes the world's deficit. And I think the de-dollarization or debasing of currency, I think those consequences would have been so much more fundamental and unpalatable. I'm okay with the short-term hit and the posturing and to create a little bit more of a playing field that kind of brings some of the controls and sense back into geopolitics. I don't know if that's how it plays out, but yeah.
I mean, even if it's posturing, let's say that's the bull case here. That's all posturing, and let's hope that the game here is to get a deal done or several deals done. I think the corporate decision makers basically are frozen.
Yeah.
Once again, and we could and if any of the supply chains, God forbid, freezes up like we saw during COVID.
Yeah.
And you get a supply shock as well. I think that's a double whammy. And then even if you want it to be a short-term thing, it suddenly sort of slips into a bigger accident. So I think there's a real risk of that.
Yeah, and the short, I don't mean like 3 months or 6 months. Yeah. I mean a year or 2 years, right? Yeah. I mean fairly long into the... Okay. And then you have the control of the Panama Canal, and there's a whole bunch of things happening in parallel. So we have never seen, I think, this much change. Yeah, and Greenland, yes. Less consequential on supply chain, but definitely up there in the list of things that are changing. Yeah. But
the problem. I hear the deficit conversation, but the problem with Trump is always it's like if you leave 1,000 monkeys in front of a typewriter, eventually they're going to type Shakespeare, and you're going to that one thing. That's a pretty good thing. The problem is he's raising tariffs. He's cutting taxes, and then he's gutting the ability to collect taxes, whatever taxes are left, and not addressing the core issues, which are the actual core spending of Social Security, Medicare, defense, and all of it's going to end up with inflation in America. It's hard to play out an upside when you put everything together. And I do agree. You pick out one thing. He's done so many things over the last 4 weeks or 5 weeks. You're like, oh yeah, that one thing, it's a good point. Kind of so what, right? So
okay, we have quickly slipped into the Trump debate, which I think everybody must have.
Yeah.
Jobs and manufacturing. Let's bring it back local.
To tech. Okay, back to Asia's business and tech. Okay, but unfortunately, the next one is also a little bit U.S. themed.
Something rational.
Well, interrelated, but TSMC, obviously the global leader in chip manufacturing, just announced another $100 billion investment in the U.S. They're building 3 new fabrication plants, 2 advanced packaging facilities, a major R&D center, all in Arizona. This is on top of the $65 billion they've already previously invested, and is apparently the largest single foreign direct investment in the U.S.
Arizona,
great golfing there,
and dry.
And super dry.
Should have chosen Texas.
Yeah.
Too much humidity.
Texas has a lot of shine.
And humidity.
Yeah, they have their shine. Okay, but were y'all surprised by this announcement from TSMC? Why now? Is it a political move? Is it Trump motivated? Is it tariff motivated?
No, so
Go ahead.
This you could have seen coming from a mile,
Okay.
right? Like everything Trump said is kind of crystallized into this particular investment. Like, so TSMC, whether we like it or not, is one of the most important companies of this age, right? Like whether, we are in the intelligence age, so to speak, and in this information intelligence era where everything from our cell phones to our computers to our GPUs and our cars and everything that's smart is
soon our brain,
Neuralink and all, is somehow, connected to an output of TSMC, right?
Mm-hmm.
And to have that in one part of the world very close to China and China's interests was never gonna fly for too long, right? And I think in some ways it's actually great that TSMC on one end, like, okay, one factor, they're investing in the US, manufacturing in the US, high-tech skilled workers, employment and output in the US, great, all that's great, right? And the other end, what we wouldn't want is the US trying to protect its interest, hence protecting TSMC or Taiwan, and then that causes another war to bleed out in our part of the world, right? So in some ways, anytime the US has tried to protect its interests, whether that be oil or semiconductors or what have you, they have militarized that part of the world. And I think in some ways, I'm glad that the $100 billion is going that way and the jobs get created there, and then there's protection and there's future to be seen. And it's probably the most peaceful way this could have happened. So I did see this coming, and I'm quite glad that this is how it played out versus any other way.
100 billion is a too big a sum. I didn't see 100 billion coming.
Oh, okay.
But it's over 4 years, right? It's not one
still, but it's bigger than like everything else thus far that they've done, right?
Yeah.
And also that now this probably won't be under CHIPS Act, so no subsidy. So for me, if I put shareholder hat on first, and anybody and everybody who invests in Asia owns TSMC.
Yeah.
Who's funding that CapEx? And what are going to be the returns on that CapEx? And when are they going to come? And how dilutive it's going to be to one of the most efficient companies in the world, certainly in Asia. And what if this is a sign of what's more to come, i.e., other corporates in Taiwan who are also on the critical supply chain path get arm twisted into doing similar capex into the US. Well, if that happens, I think the corporate lobby in Taiwan is very, very quickly going to change their support from the current administration to a more pro-China administration. And that's how this whole plan could completely backfire.
Interesting.
Right?
You're like reading the tea leaves here.
No. I'm just pointing a very sort of
the second order,
very
third order.
plausible scenario here, right?
No,
I mean, if you're going to... I was going to say, if you're going there chasing returns, it's great. But if all that's going to happen is you dilute your returns...
Yeah.
Not sure how that goes.
Peter?
No, I'm completely with Prashant on this one. Like, board members, you are about risk. So let's just talk about the risk for a second. Put whatever percentage you want on the fact that your country, where you manufacture everything and the whole IP is nested, could get invaded and your entire company goes to zero in whatever year's time. Whatever percent you have, 5%, 10%, 15%, some low percentage. But in that scenario, it goes to zero. Meanwhile, your number one customer country-wise is US. What is it? 50, 60, 70% of revenues go to the US market. And tariffs are going up. Not only am I signing this board paper off in like 10 minutes, I'm buying the house in Sedona. I'm sending the kids to America. I'm saying, get the US passport, because the whole thing could go nuclear in just like 5 years for all we know. And my job as a board member is to protect my interests, and that is the best move they can make.
I don't know. I actually really disagree. I really disagree on this, because actually TSMC's localization in Taiwan has been the silicon blanket for Taiwan.
Mm-hmm.
If that is actually a big deterrent to any sort of, non-PC activity from any party. I think the local Taiwanese commentary of the last week has not said what you guys have said. It's all been, are we losing our silicon blanket?
Interesting.
So I think we need to start thinking, like there's many different factions. I can see the America First thinking behind this, but they've had Intel. USMC was about to take over Intel fabrication. And that was another way to get more semicon manufacturing at the right scale and quality level for the future in America without requiring $100 billion investment per se. So I think somehow the chips have landed in a way where maybe Taiwan might not be as supportive of. And I think that's the tricky bit here.
And TSMC is majority owned by the Taiwanese, the government, yeah?
Yeah. I mean, I don't know if it's majority owned, but like very...
it's got a very big free float.
Yeah, very heavy. But, okay, so I think the two other factors is obviously China has been working on their own chips manufacturing domestically, and I think that's like not amazing, obviously nowhere near levels, but it's coming along, and so I think they're optimistic.
I wouldn't necessarily go to that conclusion.
What?
That they haven't broken out on the chip tech.
Oh, okay. Okay. Sure. Fair enough. And then, so I think that's one thing that maybe Taiwan has. And so I'm actually thinking about it more as a geopolitical perspective, as opposed to just like a purely business-driven returns perspective, which is like, U.S. is shaky on Taiwan's like overall political standing, and maybe this Arizona move is a way for TSMC and Taiwan to further embed itself with the U.S. to make sure that like, I don't know, they have an ally should anything come.
Yeah.
But I don't know.
I think I'll just go with the long tail asymmetric risk kind of point that Peter made. I think no board member wants that. No management team wants that. And
Scary.
There's definitely a very long tail asymmetric risk possibility had TSMC rejected any offer, proposal, coercion, whatever you might call it, to setting up in the US or doubling down on the US. And I can fully see it from the US standpoint. Like they need chip security.
Yeah.
Like, and they can't have it so far away from mainland.
Yeah. What, you want one more thought?
No, I was going to say then incentivize it. Guarantee returns.
I'm just really appreciative of Prashant putting the terminology long tail asymmetric risk to my thoughts. That's fantastic. I really feel it.
I see another haiku.
I see your haiku. I raise you a long tail asymmetric risk comment.
It's exactly what I was thinking.
All right. We're going to go more into China, which is Jack Ma back? So
Jack is back.
Jack is back. He showed up on February 17th at a symposium for business leaders in Beijing. He was, caught on camera shaking hands with Xi Jinping. Obviously, the DeepSeek founder and a bunch of the other private sector leaders were there, which we can kind of talk about. My other favorite part of this story is that a week before, he was spotted playing golf in Singapore, which I love as well. I don't know why. People apparently people were taking photos of him, and his bodyguards shooed them all away. So it feels like Jack is back.
Jack's back.
I think that's the most non-controversial part of the segment today.
That Jack's back.
Jack's back.
Everything else gets edited out.
But let's read into this. What does it mean? What does it mean for Jack? What does it mean for Alibaba? Peter.
I'm not going to read the Z tea leaves, but it's just good for tech. Here's one of the world's greatest entrepreneurs. He was in the desert for whatever years. The other part of that story is they all sat in a room and got lectured by Z for an hour and a half or something like that, which you just imagine.
You have to be rehabilitated, man.
And the amount of discipline not to look at your phone and check WeChat for an hour and a half is a lot. But I suppose the risk is very high if you do, right? The risk would be really bad, right? So, but anyway, it's good for tech. It's good. Alibaba's good for Southeast Asia. They invest a lot here. Ant Financial is an important investor in multiple companies across Asia, India, Southeast Asia, et cetera. Anything that's bad and closing down tech. The only other interesting thought is, the Chinese economy, as it recovers, maybe it's realizing, hey, we actually need these entrepreneurs, like them or hate them. As long as they act nice and don't act out and don't say naughty things that they shouldn't say, they're a force. And that's, anything like that is good for tech more broadly, because Chinese investment out of tech into Southeast Asia, into startups, is a good thing. So whatever Jack did, thank you, Jack. Thank you. Here's to you.
Raj, you mentioned some of those headwinds becoming tailwinds. How do you connect that to this?
Look, I mean, fundamentally, one of the biggest issues coming out of COVID in China was the fact that they really, really arrested the property market. And of course, the property market sits at the heart of Chinese affluence, savings, and you saw a very negative wealth effect with property prices down 20 to 30%. That, of course, introduced systemic risks for the banking system, negative multiplier effect, job losses, etc. All of that. I think all of that's reversing around at the moment, right? They've vowed great monetary support for the property market. The top two developers reported Feb numbers up 20 to 30% year on year on sales. So there's abundant green shoots in everything that wasn't working for the last 2 years. Tech, of course, adds another kicker on top of that.
Yeah.
So Jack is back, Baba is back in the black, all of that, right? I think several rhymes. I think the animal spirits are going to show next. I don't know if you saw, but consumption was mentioned 27 times in the NPC paper versus just 5 to 7 times last year. So, they're going to do everything to now get domestic consumption going. And that's part of the great rebalancing. China's going to become a much more domestic economy, more insular, sadly, but domestic. And if I'm not wrong, Ant is, again, the platinum sponsor for the Singapore FinTech Festival. So
is it?
Ant is back too.
All right. They're all back. But I mean, if you go back to the conversation we started with India, it's like domestic and foreign. Obviously, there was a huge outflow of foreign capital. I mean, do you think foreign capital will come back? I mean, it already is in some, but at the same levels that it did, because people really fled the country a few years ago.
China?
Yeah, China.
Well, hedge fund money's back.
Yeah.
I mean, David Tepper was, buy everything China, right? That was November, again, double down in December. So hedge fund, like just going by Goldman prime broking data, hedge fund allocations to China were all-time low in December.
Yeah.
Huge short positions, that's back, right? The endowment money and the US mutual fund money, I don't think that's coming back.
Okay.
But I don't think China wants it back.
Okay.
I think they're okay with it. Domestic liquidity with a 2% 10-year bond yield is phenomenal.
Yeah.
So they don't necessarily need it back. They've recapped the banking system just domestically.
You know what's funny is when you said Baba is back, Baba is also dad in Chinese. So you're like, Baba's back.
Yeah.
Like, Daddy's back. Okay. All right. That is it for the weekly roundup. And Raj, we're now going to talk about why you're actually here, which is to help us.
I'm here for you, Maria.
Thank you. Demystify and understand what's been happening around the Singapore Stock Exchange. So here in Singapore, obviously in the last week, there's been a bunch of announcements from Budget 2025. Then MAS came out with their own $5 billion fund. All of this is to basically how to figure out how they can strengthen SGX as an exchange and improve its liquidity. So can you maybe take people through like some of the top changes that you've seen over the last few weeks, and then maybe rate them in terms of effectiveness? Like, what do you think will really work?
Well, I think, first of all, SGX is doing great. SGX is not just about equities. They've got a thriving commodities business. They've got a great FX business. They've got a great derivatives business, and it's been growing and compounding very nicely. Yes, the equities piece has lost its mojo over the last few years, and SGX is not alone. Like pretty much every ASEAN bourse has been in the same bucket, right? And there are some cyclical reasons and there are some structural reasons. But I think the administration, the government, they have a very, very deep realization that if Singapore has to remain the wealth hub for the nation, you need a thriving equity market. So they're coming in at cyclical lows to boost the market, just in the way China is boosting its local economy, to boost the equity market here. It creates a much better sound foundation for future growth for Singapore as a wealth nation, right? For this part of the world. So that's the first thing, just to clarify. I think they've come out with something very good. It's a really good start. And I don't think it's stopped. There's more coming. They've already pointed to that.
You know, Hugh's not here. You don't have to say all these nice things.
No, I mean, just really saying it the way I see it, really. And I think I've been one of the parties asking for stuff. So I think that's good. But there's been a whole raft of things. Maybe I'll just touch on three really quickly. I think the first one, the big number that everybody saw, $5 billion Sing dollars.
Yeah.
What is this? This is basically money that's going to come from an arm of the central bank, of the MS, that will go straight into fund managers that are actively investing in the Singapore stock market with a bias towards small and mid caps, i.e. not just the top 30 stocks, and also are very actively happy to take positions in new listings. So this stokes demand very directly. And yes, $5 billion is not a big sum if you look at the whole market, but if you just look at the small and mid caps and new listings, it moves the needle.
Mm-hmm.
The second big thing is they've now created an obligation for family offices that want to set up in Singapore to have to contribute roughly a quarter of their whole assets into local securities. Honestly, phenomenal thing. I think capital coming into Singapore is hot money. It goes out as fast as it can come in. So this creates stickiness, a much better multiplier effect, and not just going into Sentosa condos and so on, right? So that's two. And I think just the third part, just for the companies themselves, they've really tried to streamline a lot of the listing criteria. So a lot of the reviews, which would take very long, they've been all collapsed into one single review. A whole bunch of sort of disclosure requirements are going to get brought down for the right reasons, et cetera, et cetera. So I think a lot of streamlining. There's a whole bunch of tax rebates as well, but they're really boring. So let's not touch on them today. But they're good, but not as exciting for the general market. And I think just closer to home for me, I think they have recognized that to build a very good, strong, sound market, you need better data, you need better research. I think it came out clearly in a lot of surveys that were done into these working committee meetings. So they're going to expand more schemes to drive research into the markets. And I think those will extend to companies that are already listed, companies that have filed for listing, companies that are considering listing. So all the way across that equity value chain spanning public and private markets.
Yeah. Okay. And then from a starter's perspective, do you think this is enough, right? Like here in Singapore, we talked about the India startup market, but here in Singapore, there is a long list of, there are Shopbacks, Carousel, Caros, like whatever, and there's a long list. So do you think that all these different regulation changes have moved the needle enough to actually attract some of these homegrown companies to at least explore dual listing on the SGX?
Look, it's never enough, right? We always want more all the time, right? But I think this is a very good start. I think the numbers that have come out are looking better than expectations, in my opinion. So I think it's a good start. I think what each company decides to do, I think they have to carefully consider what's the right home and location for them. To be honest, the experience of Singapore companies who went and tried to list on the NASDAQ has been extremely poor. Mm-hmm. Pretty much all of them have had to privatize and come back. There is no other natural home, in my opinion. So now you have to think, what do I need to change to make the Singapore home work well for me as well? It's not just what they are doing for you. So I think there has to be an adjustment, right? That's one. But I think you need to think a little bit broader than just those names you mentioned, Maria. I mean, we had a listing towards the end of last year called PC Partner. It's actually currently listed in Hong Kong and Singapore. Stocks up more than 180%. But there's no research except on SmartKarma. So, there are some really good stocks that are coming here already. We're going to see carve-outs of certain companies that are going to come here. I think the pipeline's looking really good. I think we saw the SGX president come out and confirm that. We saw the DBS corporate bankers come out and say that the pipeline has never looked stronger. So I'm not privy to exactly what's in that pipeline, but it's good. But it might not be just those types of names that we spoke about.
The one that I'm biased towards. Peter, what do you think? I mean, you obviously Seek is a ASX listed company. How do you kind of compare SGX? Like, what are you feeling optimistic?
Oh, look, first of all, I just want to say it was just fascinating over the last 5 minutes listening to Raj. It's really interesting. I learned a lot, and Raj, is really fantastic to hear you.
Thank you.
So really, thanks. I learned a lot. Look, Seek, it's interesting. Yeah, and I think dual listings have been out of favor for quite some time. Money's so fungible and flexible. Singtel used to have a dual listing and stopped it, right? So they used to have a listing in ASX and stopped it. Okay, well, I don't need that anymore. Money can just go. We do. It'll be interesting to see over time how it works. The one thing that resonated with me, Raj, was when you said, look, given the size of the economies, there isn't, especially with the Hong Kong market falling back, there isn't an equity market that's super strong in the region. It doesn't feel right relative to the scale of the economies, right? So I wish SGX the best, and hopefully becomes a vibrant place for startups as well.
Yeah. I think one tiny interesting point to add, right? So let's say you're a great big company in Philippines today.
Yeah.
And you decide to choose your home market to list. Let's look at a foreign investor, somebody sitting in San Fran or something, who's tied to a benchmark. Now, Philippines is a rounding error in your benchmark. No matter how good you are, it's a drip feed coming into you. That suddenly changes if you think Singapore. And as I said, it's not the end, this is the start. There could be cross connects. I mean, what did Hong Kong do to vitalize that market? It did a southbound and northbound connect to the mainland. Well, it's plausible that Singapore does maybe a connect to NASDAQ, right? Sweden did that. Sweden's got a very, very thriving bourse called First North, which I think saw over, maybe I'm getting it wrong, but it's certainly a few thousand IPOs in the last 10 years. And it's all growth equity companies, as small as $10 million all the way to $3 billion and more. We could have a Asia growth bourse, a NASDAQ Asia. I mean, a lot of these things are possible. The intent is now clear, and it's not just talk.
Yeah.
So I think that, if I put on a pure sort of markets hat on, the put is in.
Mm-hmm.
So you've got a floor in the market, and I think you'll see a cyclical rebound and hopefully a structural high, hopefully.
Would you ever do it, Prashant?
Yeah, look, I think one comment that I want to make is, look, there are a lot of good companies that are born in Singapore, but then they end up, for various reasons, listing elsewhere, right? I can speak to specifically companies that are born in Singapore, have some of the licenses in Singapore, but eventually, if they're serving a large customer base in India, eventually they become Indian companies and they list on the NSE, which is what we talked about earlier. And that's also because if those companies eventually get licensed in India, then the regulator requires them to list domestically versus elsewhere. And you can have dual listings, but that's more painful than worth. So then they end up just listing domestically for. So I think that playbook could actually work very well here as well. So I think in some ways, the MAS does have a lot of licenses that it gives out to companies like ours, where there is a large fintech built for the world from here. Those companies, eventually the expectation should be that they list here. They don't go list in NASDAQ or elsewhere. And I think if the other policies are conducive and the capital is conducive to those companies listing here and benefiting from the SGX, then I think that makes a lot of sense. But yeah, I think what would be a bit of a shame is these companies get built out in Singapore, get big with their markets elsewhere, and then eventually are forced to go list elsewhere. And then that leaves the Singapore exchange high and dry.
Yeah. I mean, I think the key word that you just said is forced to, right? It's not like they necessarily want to, is that they either have to and there's no requirement to do it here. And then previously the markets here were relatively unfriendly. I mean, I told you all before we started recording, but we kind of explored like a catalyst listing a long time ago, and there was a lot of reasons why it didn't make sense for us. But one of them, people were just like, it's not for you, right? Like there's no liquidity, and then SGX won't care about you. And so we were basically deterred from even pursuing that path and even starting down the like to check all the boxes and jump through all the hurdles.
Yeah. I think one thing, Peter, that you mentioned about like SEEK in Australia and so on, right, is Australia has captive domestic liquidity.
Yeah.
Singapore is actually such an open market that there's no captive liquidity. The Singapore sovereign wealth funds are the biggest investors in so many companies across the world, but they don't invest domestically. We don't have local benchmark funds. All these like weird idiosyncrasies that have sort of kept the Singapore equity markets from thriving. So I think now that there's intent to do something about it, and there's some sort of visible evidence, I think we've taken a step in the right direction. But we must not stop. And I think the last part is we need to do things in a differentiated way. Let's not become a me too. So let's find what are we special for, right? And I'm using sort of the capital WE here for we, but really what are we going to stand for? And hence what sort of companies naturally want to come here? I think these forced listings never really work. It's a marriage, right? Your stakeholders need to be around you. And I think Singapore already has like pretty much most of the global investors already here in one way, shape or form. That's a good starting point.
Okay. What does it not go far enough in doing? Like what else would you like to see?
Okay. This is a really obvious one and it might be coming. I don't know. But I think if one of the biggest issues that a company thinks about when it's listing is the valuation it's going to get. And the valuation is somehow pegged to what's already listed as a comparable. So to get good valuation outcomes in new listings, you need to move up the valuation of the already listed companies. How do you do that? Well, one easy way to do that is what Japan did, what South Korea is doing right now, which is get better stewardship and more shareholder return friendly things happening. A value up system, right? So can we do regulatory reform that encourages good actors to do capital returns, pay higher dividends, don't hoard cash, do buybacks, do all the things that you should be doing as a good listed corporate citizen. And similarly, well, in Tokyo, they're named and shamed. In South Korea, they created specific benchmarks. But conversely, have the carrot and have the stick. I think this kind of reform, value up reform, I think is really needed. I mean, when I look at the listed market here, there are so many companies that are trading at ridiculously low price to book valuations, exactly the way it was in Japan 4 years ago. But now they created a virtuous cycle there, and look at what's happened in Japan the last 3-4 years, right?
Why is that? Do they not have incentive to do so?
No.
Okay. So they just don't do it because
there's no carrot, there's no stick.
Yeah. So there's no reason to do so. But it creates more shareholder value, no? So why wouldn't they do that?
But, if you are the biggest shareholder of your company, there's very little float, and the board members are getting a nice, cushy salary
everyone's
anywhere.
Just like chilling.
Everyone's happy.
Everyone's chilling.
Yeah, everyone's happy. Basically, sometimes listed corporates have to be reminded that the boards, rather, of the listed corporates have to be reminded that their primary job is to watch out the interests of all shareholders, not just the main shareholders.
Okay.
So I think that's that.
Sorry, I was just like, I don't understand. Okay.
Yeah. So I think that can go a long way. And it's sort of an obvious one. Singapore stands as a sort of a bastion, a beacon for good governance, transparency, good infrastructure. So I think it fits into that playbook.
All right. Okay, that's a wrap for our very first episode. Thank you for tuning in. You can give us your feedback or nominate topics for us to talk about at 6040podcast@techinasia.com. And we will catch you in 2 weeks' time. Bye.